Get Rich Education is brought to you by Norada Real Estate, the Real Asset Investor, and Highlands Residential Mortgage.
Are you on track to achieve your financial goals? Income-producing real estate is the most historically proven way to accumulate wealth and has created more financial freedom than any other means. Norada Real Estate provides everything you need to invest in the best turnkey cash flow rental properties. Our simple, proven system will help you create real wealth and passive monthly income. Get your free strategy session with our knowledgeable investment counselors at noradarealestate.com. That's Norada realestate.com.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Welcome to Get Rich Education, episode 123. I'm Keith Weinhold, back to help you build your wealth. For today, it's really more about how you can avoid losing your wealth. Now heard in 179 nations worldwide. Thanks for being here. If you're using the Gas Buddy app to find the lowest car gasoline prices, then this is not the show for you. You're losing your time and you're exerting your mental bandwidth and energies on the things that are never going to make an impact in your life. Dude, that is not moving the meter. Is that really how you're choosing to live? What if the value of your income property portfolio fell 40%? How would that make you feel? We're going to talk about how to avoid that. And if it did happen, what you would do. Also, I'm invested in one real estate market where there is a recession. Yes, I own income property in a market where there's a recession myself. How could that happen to me? Aren't I the one that's always talking about the importance of the real estate market over the property? I'm going to tell you how I deal with being invested in a real estate market where there's a recession. So we're talking about mistakes to avoid in real estate investing today. 3 weeks from today, Rich Dad Poor Dad author Robert Kiyosaki will be back here with me on Get Rich Education for his second appearance, that highly quotable Mr. Kiyosaki. That's in 3 weeks, and then sometime after that, Rich Dad Real Estate Advisor Ken McElroy returns to the show here with us. I am in sunny and warm San Juan, Puerto Rico today, and as things were being set up logistically and acoustically for the show here in Puerto Rico, I was just thinking that, most people, I'd say really 80 to 90% of real estate investors buy property without any rationale-backed strategy, and they really can't explain why they even own the properties that they own anymore. You want to practice zero-based thinking. Zero-based thinking basically means knowing what I know today. Would I buy this property today that I still own here? And if the answer is no, then you got to consider selling it. Real estate investors often hold a property in their portfolio for reasons like, just because they bought one in the town that they grew up in or the town where they went to college. Or another common one is where, a man and a woman live separately and then later they might marry, move in together, and they might move in where the husband lived already. And then rather than, say, the wife's selling the condo that she used to live in, that she just vacated, instead, she holds on to it and then rents it out for cash flow. So I think a lot of amateur investors do something like that out of convenience, yet there's no other strategy or rationale behind that approach. And that's typically not a profitable approach. So if you own some rambling ranch home because your Aunt Doreen and Uncle Bill used to live there, and you bought it just because, they said the roof never leaked and the plumbing always works, you figured it was a good home, and you feel nostalgic toward it because you used to play wiffle ball in the backyard there when you were a kid, well, that's what I mean about owning income property with a sound strategy instead, okay? Owning what used to be Aunt Doreen and Uncle Bill's rancher is, say, that's a $100,000 home that gets you $650 in rent. Well, you could have bought a turnkey property in Birmingham and get, say, $1,050 in rent for a $100,000 home, or buy in Memphis and get $1,100 for a home at that same purchase price. Plus, you're probably self-managing the ranch home where your aunt and uncle used to live, and a turnkey property in, just say, Birmingham or Memphis, that already has the management built in, so your income is passive, you're not landlording, and your yield is better at the same time, and you're buying it already renovated when you get it from a provider like that. So instead of holding on to what's already familiar, you'd be getting both a lower cash yield and getting interrupted and losing your time self-managing it. You know what's strategic? Here's what's strategic, okay? And this is not conventional to most people. You know, one of the things that I read about when I was performing my due diligence on the Memphis, Tennessee market, investing in Memphis income property, I read about 3D printing. Yeah, 3D printing. Memphis has an outsized distribution sector with what's there. It's America's distribution hub. Not just having FedEx based there, it's even more than that. It's all of its concentration of trucks and trains and forklifts and planes. I needed a good answer for myself that 3D printing was not going to significantly disrupt the distribution industry anytime soon. And I basically formulated a conclusion after that from the research that I did that things are going to be good. Basically, you'll still need to ship the big stuff through Memphis. And even with the smaller items, you'll still need to move the material that the printer prints things with anyway. So, well, was that an unconventional approach that I took right there? Okay, yeah. I mean, at that time, someone could have asked me, what are you doing over there, Keith? And I would have answered, I'm preparing to buy real estate by reading about 3D printing. So unconventional, yes. Is that strategic? Yeah, I think it is. All right. It's either thinking that way versus buying a property because I used to play wiffle ball in the backyard. So see, as buy and hold investors, we need to look for areas that are growing. So that's why I'm looking at long-term economic trends. Okay, long-term doesn't matter with house flipping or wholesaling, because with flipping or wholesaling properties, you expect to be in and out of a property in less than a year. Well, long-term matters with buy and hold. Use desktop methods to buy your income property, okay? Research your chosen turnkey city's economics to be sure the economy is growing. Use Google Street View to explore neighborhoods. Only travel to the property post-inspection if you travel there at all, or have WeGoLook.com do that for you instead. Have your property manager send you a video walkthrough of the units quarterly or twice a year, and basically use some of your cash flow to pay a team that you have on the ground to manage it for you. Do all of this rather than be a landlord and live a peaceful, predictable life. That's why we're doing this. So we're talking about how to avoid losing in buy and hold real estate investing today. One thing I've seen amateur investors do to avoid losing is they figure they'll make a big down payment on a property. They rationalize that instead of putting 20% down on a property, they'll put 50% down, and then with the resultant lower monthly mortgage payment, they've guaranteed to increase their cash flow. Well, in almost every case, I strongly contend that that person is thinking about investing the wrong way, because with a higher down payment, you didn't really create cash flow so much as you had to buy and pay for that cash flow, okay? You've just increased your equity position and lowered your leverage ratio, and you've hampered your ability to buy more property. I mean, really, virtually any property could cash flow if you put a 100% down payment on a property and had zero leverage. So if you can't create cash flow from a small down payment, well, then you've really got problems with the rent to price ratio that sub-market yields, and you likely need to look somewhere else. Well, I asked you earlier about how you would feel if the value of your income property fell 40%, all right? First, let's look at what happens to a stock investor when there are price fluctuations, and then next we'll compare that to real estate. The stock market doesn't move sideways for very long. It's either up or it's down, and it's been up for a few years now. The Dow Jones crossed the 20,000 mark for the first time not long ago. You're seeing more and more media articles celebrating all-time stock market highs, such that increasingly savers that have money parked on the sidelines, they feel like they're missing out. And anyone that's already invested they want to buy more oftentimes because they experience this recency bias, this momentum effect that they're making money and it feels so easy to make money. And in the meantime, you've got that saver over there on the sidelines that reads another article, this time that the S&P 500 just hit an all-time high, and they start experiencing more fear of missing out, FOMO, FOMO, from being on the sidelines. And then their friend that's in the market tells them that, oh, their Netflix stock was just up another 5% from the last time they looked. Okay, and the saver over there on the sideline, they're thinking about getting in. They read another article. This time, the NASDAQ hit an all-time high. And by this point, the one on the sidelines gets so tired of missing out, so tired of thinking about the fact that they might have to work longer than their friends because that person, he's not invested in stocks. He's so steeped in financial media that trumpets this euphoria that investor on the sidelines finally breaks down and buys. He's tired of everyone else making out well, and he's not getting in on the fun and the action. And he rationalizes that he's just so sick of missing out and feeling excluded. No matter what happens, now at least he'll be included now that he's invested in the market. You know what that investor just did? He bought high, the very opposite of what you're supposed to do because he gave into emotions, okay? So he bought high, but we'll say he never bought exactly at the peak. It's very difficult to time that exactly. The market typically has a little upward run left in it, and then the stock market reverses course and it starts to go down. So we'll say that shortly after this investor bought, what happened is what often happens. Valuations get frothy. Quarterly earnings reports begin to disappoint investors, and price to earnings ratio just got so disproportionately and historically high due to all these really speculators like our investor here that came off the sidelines. And now the stock market starts a slide. And soon that investor that bought high is concerned that the market has slid so much that he's now lost 10% from where he started when he bought high. But the media refers to this as a correction. And his mutual fund manager reinforces that and tells him that, yeah, it's just a correction. So the investor rationalizes that he can stomach this 10% loss now because it would be dumb to sell for 10% less than what he bought his stocks for. All right, so some more time passes and the stock slide continues. So now the investor is down fully 20%. And that's the marker for bear market territory. So he's looking at a 20% haircut if he sells now. So it's getting a little bit difficult for our investor that came off the sidelines so late, but he stays the course. With the passage of more time, the stock market falls 30% from where it was. Now the investor is reading more articles about companies that have gone bankrupt, business plans that have failed. So some of the companies that once stood are just poof, gone. They never had any earnings. There was no fundamental basis for that stock's valuation. And at this point, the investor down 30% from where he started is seriously concerned. He starts to figure that as much money as he's lost, he projects himself now maybe having to work longer into retirement and having a shorter retirement. And that converts to less quality time that he'll get for the balance of his life with his own family. And it's hard for him to stop looking at this discouraging news and the depressed share prices of his stocks. And he is just bleeding down 30% now, just financially bleeding. He is emotionally taxed. He's tired of looking at it as he's figuratively bleeding, losing 30% of his substantial investment now, and the stock market falls another 10%. It's now down 40% because investors are so discouraged that other investors start selling, and a number of investors have panic sold. And our investor that we're following here, now down 40%, has financially bled so much that he fears financial death. He fears financial ruin, and he fears even more uncertainty is ahead. At this point, he so badly wants to sell his depreciated stocks because he just wants the pain to end. And you know why the pain hurts so bad for stock and mutual fund investors? It's because so much of the balance of their account value, that's money that they worked for. They grinded for that money as an employee at a job. They traded their time for those dollars. They sold their time that they could have spent with their family for that money that's now just gone. And in their workaday job mind, they're going to have to work even more just to get back to where they started, and therefore lose even more time with their family or be robbed of even more time from doing what they love. And when the pain and bleeding have gone on for so long, after a 40% loss, the investor tells his wife that he wants to sell, and she agrees, because after all this bleeding, you're just looking for one word so badly, so desperately, and that word is certainty. You just want to find some certainty, and that what's actually going to be yours is going to stay yours for a change, and that you're not going to lose anymore. And he just wants to know if he wakes up tomorrow that any bad news will not affect him. And our stock investor finally does break down and sell after being down 40% from where they started, because he just wants this excruciating pain to stop. So he shifts his investment from stocks to a money market fund. And that way the certainty can finally start. He's just thinking, thank God that is over. And what has our investor done? He has now bought high, and then he just sold low and made both moves at precisely the wrong times. That's exactly what most people do. We are emotionally and biogenetically predisposed as human beings to act exactly that way. And that's why most stock investors have a real rate of return of 0%, or often even less than 0%, primarily on that basis, on that emotionally adjusted basis, for just that reason. And then on top of emotion, you factor in fees and inflation and taxes as well. And no wonder the stock and mutual fund investor never got ahead. Emotion is exactly why stock investors fail, even when they think that they have things under control, or that it's different this time, or that they'll be smarter this time. And even if you're not directly controlling the purchase and sale of your stocks, your mutual fund manager, either inside or outside your 401k, they're behaving that way, and that's why they can't beat the S&P 500 over time, and they're supposedly professionals. Since the Great Depression of 1929, there have been 25 stock bear markets. That's an average of one every 3.4 years, and we haven't had a bear stock market now since March of 2009, so do some math, and you'll see that we are quite overdue. Many of today's investors have lived through two fairly nasty bears, a decline of 58% from 2000 to 2002, and then a 57% stock plunge from 2007 to 2009. Bear markets spook investors who are not prepared for them. Millions of investors are actually still nervously on the sidelines following the market rout of 2008, and by remaining in cash, they've missed out on a recovery. And you know when they're going to jump back into the stock market? Yep, right about the time it crests at the top. I'm going to talk shortly about how that experience is different for a real estate investor. We're talking about mistakes to avoid in real estate investing today. One way to avoid losing that I'd be remiss if I failed to mention to you is a smart way to keep what you've got, and that's by engaging Rich Dad Advisor Garrett Sutton's company, Corporate Direct, to incorporate your real estate. And they also maintain your entity to help protect you in our litigious society. Corporate Direct is exactly who I've looked up for my own needs, and it's who Rich Dad author Robert Kiyosaki uses. And, you know, Corporate Direct's prices are actually surprisingly affordable for the everyday investor. In fact, when you get a hold of Corporate Direct, mention Get Rich Education with Keith Weinhold, and they'll give you $100 off your formation just like that. It's corporatedirect.com. What would happen if your income property portfolio ever fell in value 40%? How would that feel? That's next. This is Get Rich Education. Are you looking to invest in your first investment property or grow your existing inventory? Highlands Residential Mortgage can help, offering down payments as low as 15% and credit score requirements down to 620. Their streamlined process is designed to help investors close their loans quickly and without any surprises. You need someone who knows cash flowing real estate and can help guide you through the muddy waters of today's lending environment. So call Graham Parham today, toll free at 855-326-6802. The Parham team can help you purchase or refinance any of your 1 to 4 family investment properties.
NMLS number 195724, 12001 North Central Expressway, Suite 750, Dallas, Texas 75243. Equal housing lender, not licensed in all states.
As a lot of investors know, multifamily real estate has been one of the best asset classes to be invested in most of the last decade. While the great deals have been harder to find lately, there are still opportunities in select markets where savvy investors can get lots of appreciation and strong cash flow if you have a great team. Dave Zook, founder and president of The Real Asset Investor, and his team have been very active in the multifamily space in Memphis, Tennessee. On the heels of the Great Recession of 2009, Dave and his team quietly started acquiring multifamily assets, and in the last few years, he has syndicated over 2,000 apartment units, creating strong cash flow streams and big appreciation for lots of their investors. It's not too late to get involved. If you're an accredited investor and you would like to learn more about investing in great multifamily apartments with a world-class team, email Dave and his team at info@therealassetinvestor.com.
This is Rich Dad, Poor Dad, author of Robert Kiyosaki. Listen to Get Rich Education with Keith Weinhold. And the reason I respect Keith, he's a very strong, smart, bright young man.
Welcome back to Get Rich Education. So yes, I am in sunny and warm San Juan, Puerto Rico today. I've been touring around Puerto Rico here with economist and author Harry Dent. You've heard Harry on the show with me here twice. And Harry knows how to have some fun too. Yeah, I know he talks serious stuff between the lines here, but he's not like the Bill Belichick of economics or something. He's not always talking about gyrations in the bond market or Japan's debt to GDP ratio. Next week, I'll be coming to you from the Eastern Caribbean island nation of Barbados in Bridgetown, Barbados. And then the following week, it's back home to Anchorage, Alaska. Around 2008, 2009, most United States real estate markets lost value. Some of them lost value fairly quickly. Previously, prices were pushed up to these unsustainable levels because nearly anyone could qualify for a loan in the very early 2000s. Sometimes to get a loan, you didn't even need to show the lender what your income was, or if you had to show it, you didn't need to back it up with anything to verify what your income actually was. That was called a stated income loan, okay? Just state your income, and the lender will just trust that you're not lying, okay? They'll never look for your income on your pay stubs or your W-2 or your tax documents. If you had a heartbeat and you had a signature, you qualified. Well, that spurred demand and stoked prices to unsustainable levels, and borrowers bit off more house than they could chew. And soon, when borrowers couldn't afford their high mortgage payments because their income was not as high as they stated, well, the resultant defaults and subsequent real estate price meltdown, that caused a lot of pain for a lot of people. A lot of other things led to that condition, too. Loan-to-value ratios of 105% were out there, meaning that you could borrow more than what the property was worth. Negatively amortizing loans where your monthly payment didn't even cover the principal were out there. In some markets, real estate prices did fall 40%, and they hadn't fallen nationwide in decades. And it doesn't happen nearly as often with real estate as it does stocks, but let's just say that that did happen to your income property portfolio, that prices fell 40%. Well, that's not going to feel good, but you're not going to go through the same emotional anguish as the stock investor because you bought your property primarily for the production of cash flow. And I had real estate value happen to me back then in a small measure when in 2009, some of my properties lost 10% of their value. But say your real estate fell in value 40%. But see, it still provides you with that monthly cash flow check in the mail, regardless of what your capital value is. So, well, how badly would you really want to sell your real estate if the value were discounted 40% from where you bought, if a tenant still pays you every month while they live there? So how badly would you want to get rid of something that pays you monthly cash flow? You probably won't feel any great sense of urgency to sell if you wanted to sell at all because it pays you as you hold it. So real estate is less liquid than stocks, So you're also less prone to panic sell like our hapless stock investor that I described there would have been. It might take you up to 60 days or even longer to sell real estate. You can't just point and click and sell real estate low based on a whim, based on an emotion. You need to go through a series of actions to your property before you sell it. You might need to make some repairs, enlist an agent, go through the process of listing it, consider various buyer offers and all that, all while it's still paying you every month. And you can believe that if real estate prices fell 40%, well, then banks are going to be pretty skittish about giving any new loans to people because banks get nervous about the value of their collateral that borrowers are borrowing against. So when people that want to buy in this condition, when they can't get loans, well, then they've got to be renters, and that can push up rental demand, and that can push up rent prices. So you may very well be cash flowing even better than ever on a monthly basis, even though during that time, the capital value of your asset has temporarily fallen. So you really don't feel an urgency to sell low when you're getting paid better than ever. So think about your stocks losing 40% of their value versus your income property portfolio losing that much value. With stocks, you felt a pit in your gut because you traded a lot of your time for those dollars. And with real estate, chances are you only put 20% down and you borrowed 80% from the bank. So up to 80% of those dollars that are temporarily lost weren't even yours to begin with. Now, we're going to be responsible, repay the loan. And you really don't even do that because those principal payments, they are outsourced to the tenant, as are the interest payments. But see, as the investor, you're not going to have that temporary feeling in your gut that feels awful that you lost money and that you sold time with your family for. Basically, in a stock meltdown, some companies that didn't even have any real earnings just disappear. Those companies just go away. Poof, they're gone. They're not coming back. With real estate, there is no poof, gone. You still have that asset. You still have value in the home's brick, the home's wood, the home's concrete, the window glass, the home's copper wire, all kinds of petroleum products. Plus, you still have the value of the land that it resides upon. You still own something substantial there in a worst case scenario. So that's another reason why we're into real asset investing here at Get Rich Education and not so much paper investing. So that's really an overview of how it feels for a stock investor versus how it feels for a real estate investor in a losing market. The stock investor is so much more likely to sell low, whereas a cash flowing real estate investor, you won't. And if you buy for cash flow in a growing market, you'll often still be paid on that monthly cash flow basis, and you wouldn't even want to sell low. Your income property portfolio is far less likely to fall 40% in value than stocks are, because here we talk about investing in more stable markets, typically in the Midwest and South, and not the volatile Manhattans and San Franciscos of the world. 10 years ago, during that real estate price drop, those stable markets in the Midwest and South didn't drop in price so much. Warren Buffett's rule number one of investing is simply don't lose money. And why is it don't lose money? Well, part of it has to do with math. If your investment loses 25% of its value, it's just a mathematical inconvenience that it needs to rise 33% just to get back to even. If your investment loses 50% of its value, it needs to rise 100% to get back to even. So invest in something more stable. Warren Buffett's rule number one, never lose money. And as an investor, you should know that fact trumps emotion, but, we're all just emotional creatures, and that can very much make one do the wrong thing. Well, I told you at the top of the show that I'm invested in a market that's in a recession. Yes, I own income property in a market where there's a recession. And that place is back in my hometown of Anchorage, Alaska. That entire state is so dependent on the price of a barrel of oil that I actually don't consider it a stable market like we often find in the U.S. Midwest and South. You likely don't invest in Anchorage, but this is just a concise little case study that applies to a lot of places. You probably know that the price of a barrel of oil was cut in half in recent years. That meant that the oil industry couldn't afford to keep as many people employed, consequently, and layoffs were announced. Now, a lot of us don't really serve these higher paid oil professionals and oil workers, but there is a trickle down effect. If the oil industry family, they had a parent in that family that was laid off, well, that whole family is more likely to just leave the state. Well, now that's an entire family that no longer patronizes restaurants in an area. They no longer need to get their hair cut in that area. They no longer buy cars in that area. And now those people, they're the ones I serve with apartment building units, like a food server at a restaurant or a car salesman. So that's why it hurts. In fact, Anchorage's population lost 1,500 people over the last year. That's about 0.5% of the population. And if you find yourself in a declining market, look out. Some people, now most real estate agents are pretty good, but maybe an unscrupulous real estate agent might try to tell you that condition is good for income property investors, and that's not good. That person might contend that now there's going to be more rental demand because no one wants to buy in a declining market. Well, that right there, that is a bunch of BS. That is a bunch of BS, blue sky, because there might not be anyone there in that market to rent or buy. People are just leaving. The entire metro economy is contracting, and that is a much bigger problem. All right, so if Anchorage is not a stable market, then why in the heck am I invested there? Well, there's really two reasons. Number one, an in-state financing program where I got great rates and terms. And number two, the sub-market. Okay, let me explain the sub-market. Before I bought in Anchorage, I bought disproportionately more income property near the medical district because everything that I read and continue to read here still in 2017 is that medical jobs are going to continue to grow faster than really any other business sector. And most metros out there have one or more parts of the city with a sprawling medical district. And a few years ago in Anchorage, I strategically bought there near the medical district. Now, again, chances are you don't invest in Anchorage, but this just provides you a glimpse of how you can think about buying strategically in other markets. So in the midst of an Anchorage economic recession, okay, here are the numbers. Here is the change in employment numbers year over year across business sectors. Okay, just listen to this. Oil and gas, that sector lost 700 jobs year over year, so minus 700. Construction, also minus 700. Professional and business services, minus 1,100. Retail trade, minus 300. So that industry lost 300 jobs year over year. Transportation, minus 100. Government, minus 100. Financial activities, lost 100 jobs year over year. Leisure and hospitality, minus 100 as well. And then the last category that's broken out is healthcare plus 900. Yes, healthcare plus 900. That sector added 900 jobs in the last year. And now I wish I had those numbers in percentages rather than absolutes, but I think you get the picture there. So although Anchorage's total market employment overall is down, within the health sector economy, it is up. And a few years ago, when I bought those apartment buildings, this was completely predictable. Okay, I didn't have to be a genius to figure this out. Due to demographics and the aging population here and really most places in the U.S., this was just a completely foreseeable condition that healthcare was going to grow. And that's why I bought next to the medical district. And healthcare is projected to continue to grow faster than most all other professions and business sectors. It's kind of like Ken McElroy says when he's on the show here, real estate is dumb and slow. I love that. Real estate is dumb and slow. It's just not difficult to kind of get on top of this problem. So to avoid losing in real estate, buy right. So that way I still got the in-state financing, and that's why I still have great occupancy in my Anchorage income properties. Now, although my occupancy is really great there, the amount of rent that I can ask for is down a little bit as I think there are just fewer dollars circulating in the larger Anchorage economy due to the larger slowdown from declining oil prices. So I have felt something negative from that, but I've hedged myself against a more significant pain. You cannot control the wind, but you can direct the sail when you're out there navigating. You can't control the wind, but you can direct the sail. So that's being strategic. A huge way to avoid mistakes in real estate is by buying right in the first place. And it's not hard to do. Real estate is dumb and slow. Of course, perhaps more importantly, is to avoid the mistake of owning property in just one U.S. metro market. So when I factor in the lower rent incomes I'm getting in Anchorage with the higher rent incomes that I'm enjoying in the other metros that I'm invested in, well, those lower Anchorage rents are almost negligible to the big picture since they've risen in the other markets. And most people make the mistake of buying real estate in just one metro, and it's typically the metro that they live in, and that's riskier than they'll ever know. I lower my risk by being in different markets. I like to see you ultimately diversify across 3 or 4 or perhaps even 5 different metros. You might predominantly be in cash flow markets like Memphis or Indianapolis or Birmingham, and then also be invested in 1 or 2 higher growth markets where you believe you'll get equity growth, yet you aren't negatively geared, maybe an equity growth market like Dallas-Fort Worth. So then when your equity properties run up in price in those appreciation markets, you can either refinance or 1031 exchange and take that equity and plow it into more cash flowing markets. And then later when the cash flowing markets that you're in finally experience their equity growth after the appreciation markets did, you can reinvest that, build up equity. So that's really the formula right there. So see, real estate is so slow moving that you can often get ahead of it. And there's really not one omniscient source for reading about these types of trends either. It's about being proactive and buying right in the first place, like reading about 3D printing with Memphis, or in a smaller market like Anchorage, Alaska, that's not as diverse as most markets, strategically buying close to the stable medical sub-market inside the more volatile, larger market that's more subject to oil price swings. So you've been learning about mistakes to avoid in income property investing, and this certainly isn't an all-encompassing show about everything to avoid. That would take like 500 episodes to discuss, but there are some big picture considerations. One smaller thing that comes to mind here where income property inventory has tightened considerably in a lot of places and competition has really run up these last few years is please don't forego your property inspection. Property inspections are a great form of cheap insurance for you before closing on your turnkey property. Of course, you should even get an inspection on new construction. I mean, you don't think they make mistakes in construction. So if you make an offer on a property and then you're afraid that it will be, say, 2 weeks later until the inspector can come out and that holds up your timeline, well, one thing you can do is schedule your inspector to come out before you even make an offer if you feel like you've got an offer coming on a property. And then you could cancel the inspection if you had to. And of course, you'll be courteous and give your property inspector plenty of notice if you have to back out. But see, at least you'll have your space reserved ahead of time, and that can keep you moving ahead on your timeline. And I encourage you to not skip your inspection. So we spent some time discussing how to avoid losing money in real estate. More importantly, how do you avoid losing too much time? That's with something like turnkey real estate investing, probably my all-time favorite way to invest and invest in real estate. Well, how do you find the right market and the right team yourself? That's been compiled for you at GetRichEducation.com under the Resources tab. Take action there, read the market reports about various markets, and then follow up with the preferred provider in that market if that resonates with you. That's at GetRichEducation.com under the Resources tab. Oh, I hope that you learned about some key mistakes to avoid in real estate investing today. Until next week, I'm your host, Keith Weinhold, signing off from San Juan, Puerto Rico. I'll be back with you next week to help you build your wealth in a new way that we've never discussed before. Don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education LLC exclusively.
Cash flow real estate investors nationwide and worldwide, this is Get Rich Education's Keith Weinhold. Forbes has rated Memphis, Tennessee as the #1 cash flowing market in the world. Our good friends at Mid-South Homebuyers have been Memphis's premier turnkey real estate provider for 14 years with a stellar reputation and an A+ rating with the Better Business Bureau. Owner Terry Kerr was born and raised in Memphis. Yeah, he knows the market and has renovated and sold over 1,000 houses in the Memphis area. Find out what their many repeat buyers already know. Their houses are completely renovated, even come with a 1-year builder's warranty and a lifelong rental guarantee. They're a perfect fit for the first-time out-of-state investor or the seasoned investor diversifying their portfolio. Mid-South Homebuyers' friendly staff makes investing easy. Learn more at midsouthhomebuyers.com or give them a call at 901-217-HOME. The preceding program was brought to you by your home for wealth building, GetRichEducation.com.